Welcome everyone to a new episode of Learn English with the News.
I'm doing great, Adam. Thanks so much for asking. Yeah, I'm really happy to be here for this one.
Awesome. So today we're going to explore, why tech news is actually one of the best ways to learn real English. And hey, just a quick tip. If English isn't your first language, you can always turn on the YouTube subtitles to get that real-time translation while you listen.
Oh, absolutely. And today's topic, it's just perfect for anyone learning business English. We're tackling a huge question in the world of finance and tech right now. Is there an AI bubble? But, and this is the important part, we're going to break it down with really simple words.
Exactly. No jargon, no complex language. We're talking about real vocabulary that you'd actually hear at work, in meetings and reports, on LinkedIn, or just reading business news. Okay, so before we dive into the main topic, let's just do a quick reminder. Sarah, why is tech news so good for learning English?
Well, for one, it uses really modern vocabulary, and you see the same structures, they pop up again and again. You're constantly hearing words like growth, risk, investors, market, demand, strategy, all the time. And the sentences are usually pretty short and direct, right? Which, really helps if you're a learner.
Totally. And you also pick up these really useful professional patterns, phrases you hear all the time.
Yeah, like there are growing concerns about, or analysts warn that.
Oh, yeah. Or investors are pricing in. That's a big one.
Exactly. And you're going to hear these patterns a lot today. So the idea is you just kind of learn them naturally without even trying too hard.
All right, let's get into it then. Let's define the main idea, an AI bubble. Sarah, what exactly is a bubble in simple terms?
Okay, so a bubble is basically when prices go up way too fast, and it's mostly for emotional reasons. People get really excited, they get that, fear of missing out, exactly, FOMO, so they buy just because, well, everyone else is buying.
So prices are rising because of hype, not necessarily because of real, concrete results.
That's it. I mean, in a healthy market, prices grow because profits grow. Simple. But in a bubble, the prices are growing way faster than the actual profits.
Okay, let's add an important business word here, valuation. A company's valuation is essentially what the market thinks it's worth.
It's market value. And here's the key problem. Some of these AI-related companies, they have these incredibly high valuations, but their cash flow just doesn't match up.
And cash flow just means real money coming in and going out of the company.
Yep. So if a company has a huge valuation, but weak cash flow, experts start to ask, okay, is this price realistic? And that question really is at the heart of the whole AI bubble discussion.
Okay, so now for a big warning sign, and that's looking at what the really large investors are doing. And recently, we've seen several major investors selling their positions in a company called NVIDIA.
Right. And NVIDIA is a huge player. They're a key company for AI because they sell GPUs, these super powerful chips that you need for AI computing.
And when the big money starts selling a lot of stock, people, well, they pay attention.
They definitely do. For example, some investment funds sold their entire NVIDIA holdings. That means they completely exited their position.
Okay, this is a great chance to teach two useful verbs. First, to sell off, which means to sell a large amount of something, often pretty quickly. And second, to liquidate, which is even stronger. It means to sell absolutely everything in a position.
Right, and the message behind those actions is pretty clear. Some big investors think the stock price may have gone too far too fast.
And then you have another famous investor who actually took short positions.
And taking a short position is basically betting that the price will fall. It's like saying, I think this stock is overvalued.
Which brings us to a really important phrase for our learners. The market may be overvalued. Overvalued just means price too high.
So let's talk a bit more about why analysts are using words like excessive to describe these valuations. Well, a lot of these AI companies are priced for a perfect future. Investors are expecting just massive growth. And those high expectations, they can be pretty dangerous.
Because if the reality is just good, but not perfect, the stock price can still drop a lot.
Exactly. Markets don't just react to results. They react to results compared to expectations.
That's such a key professional idea right there. It's not about good news or bad news. It's about news versus expectations.
And another point is that some analysts are saying these tech valuations just aren't supported by profits or stable cash flow. So they're asking, where's the money? Where are the consistent profits? And if that answer is unclear, well, confidence can weaken really fast.
Okay, this next term sounds complex, but it's not. Circular transactions. Let's make it simple.
Yeah, let's do it. A circular transaction is just when money moves in a circle. Imagine company A pays company B, but then company B uses that same money to buy something from company A.
Okay. So on paper, it can look like strong demand for company A's products, but the demand might be sort of created inside the system.
Exactly. It can inflate the numbers and make demand look way bigger than it really is.
The important word there is artificial. Artificial demand. It's not fully organic or natural.
And if demand is artificial, that means the growth is fragile. If that circle stops for some reason, the sales can just drop off a cliff. And that's why analysts are always watching the fundamentals.
Fundamentals, meaning the real economic base of the company, sales, profits, cash flow, real customers. Right. So this leads to the big fear. What happens if the AI bubble actually bursts?
The key word here, Adam, is contagion.
Contagion. Like a disease, it means a problem spreads from one area to many others.
Yes, if tech stocks fall sharply, investors might panic and start selling other things too, other assets.
So the crisis doesn't just stay in tech, it could spread to the entire market.
And then confidence just drops. And we're not only talking about investor confidence, but business confidence too.
Right, so companies might delay hiring people, consumers might start to spend less money.
Exactly. And all of that can affect the real economy, jobs, banks, overall growth. So you see, it's not just a tech story. It's really a financial stability story.
That's a great point. And a lot of people might be thinking, well, I don't invest in tech stocks. I'm safe.
Yeah, you hear that a lot. But many people are exposed indirectly.
How so? Like through retirement funds or global index funds?
That's exactly it. Because these huge global funds, they often hold a lot of US tech companies. So even if you never personally bought a single share of NVIDIA, you might still have exposure to it.
And the useful phrase here is indirect exposure.
Indirect exposure just means risk you have even if you didn't choose it directly. And it's really common vocabulary in professional finance conversations.
Okay, so with all this risk floating around, what do the experts say investors should actually do?
Okay, number one, and this is the big one, don't panic. Panic selling is almost always a bad decision.
Right, because if you sell after a huge drop, you lock in your losses.
Exactly. You turn a loss that's just on paper into a very real loss in your bank account. Second, focus on your long-term plans. And long-term means thinking in years, not weeks.
And third, I'm guessing, is don't try to time the market.
You got it. Timing the market means trying to sell at the very top and buy at the very bottom. It's extremely difficult, even for the top professionals. So the advice is actually pretty simple. Just stay disciplined.
Okay, so that leads us to probably the most practical strategy of all. Diversification.
Yes, diversification just means you don't put all your eggs in one basket. You spread your risk around.
Right, so you spread it across different sectors: tech, utilities, insurance, consumer goods.
And across different assets, like stocks, bonds, maybe some gold.
And even across different countries: the US, Europe, Asia.
Exactly. That way, if one area falls, your entire portfolio isn't destroyed.
There's a very useful sentence in English for this. Diversification is risk management.
And here's another one. Don't bet everything on one trend.
Okay, perfect time for a mini English training session. We're just going to quickly repeat the key vocabulary we covered.
Yes, so just listen and repeat them in your head. Ready? Bubble, price is too high because of hype. Valuation, how much the market thinks a company is worth. Cash flow, real money coming in and out. Overvalued, priced too high. To liquidate, to sell everything. Short position, a bet that prices will fall. contagion, a crisis spreading to other markets, and diversification, spreading risk across different investments.
Awesome. And here are 3 professional sentence starters you can use. Number 1, there are growing concerns about.
Number 2, some analysts warn that.
And number 3, investors are worried that. Seriously, if you can use those 3 structures, you will instantly sound more professional. So to wrap things up, some experts are worried about an AI bubble because valuations look very high and some of the big investors are starting to sell.
And if that bubble were to burst, the impact could spread across all the markets. That's why professionals are always talking about long-term thinking and diversification.
And for you as an English learner, a topic like this is just perfect practice for real-world business English.
And remember, you don't need perfection. Just try to listen to a little bit of English, maybe 10 minutes, every single day. Consistency always beats intensity.
Thanks so much for listening to Learn English with the News.
We'll see you in the next episode.